Hey, this is Matt from InvestiQuant. Today is Friday, September 18th, 2020, and today is options expiration day. And the markets are pretty flat here in the overnight session. We're up just a couple points at the time of this recording, so I have no idea which way we're going to be opening, but we're opening fairly flat as of now. So what I want to do this morning is take a look at what has happened historically on options expiration day when you're opening within the prior day range. And I'm going to use the prior day range since I don't know if we'll end up gapping up or down this morning, since we're opening, or since we're trading pretty flat right now. So let me set this up. We'll look at all four instruments. The setup is entering long at the open, which is 9:30 a.m. Eastern Time. The exit is set to the close of regular trading hours, which is 4:15 p.m. Eastern Time. Now, in opening filters, like I said, we're just going to use opening within prior day range because I don't know if we're going to be opening up or down. I will tell you the up gaps are a little bit more bearish in this scenario. So I would encourage you to come in and dig into this more on your own after you see what I'm doing here to give you an idea of some other things to look at. But I would be looking at gap direction once we get closer to the open, and the up gaps are a bit more bearish. You could also play around with gap size as a percentage of the 5-day ATR or something like that as well to zone in on the opening zone once we know exactly where we're going to open a little bit closer to 9:30 a.m. Eastern Time. Next, I'm going to go into the indicator section, and I'm going to simply put this above a 200-day simple moving average. And I'm just going to use the 200-day moving average because we don't have a ton of samples when you're using a event that takes place once a month and then you add an opening filter to it. So I'm just going to use above the 200, but you can use a short-term moving average as well if you'd like. And then lastly, I'm going to go to the market events section, and I am going to go to market events, options expiration day. That is right down here. Click equals and then hit view results. And here we go. So these are the results of going long at 9:30 a.m. Eastern Time on options expiration day when above a 200-day moving average and you're opening within the prior day range. The exit is 4:15 p.m. Eastern Time, which is the close of regular trading hours. Historically, the S&P has 99 samples here dating back to 2003. The NASDAQ has 112, the Dow 93, the Russell 105. Win rates on these a little bit weak here in the S&P, coming in at 45%. NASDAQ the weakest, 39%. Dow pretty break even here on win rates at 51%, as is Russell about 50%. So those two pretty neutral on win rates. The S&P and the NASDAQ a bit weaker. And taking a look here, average win, average loss. You can see the average loss here in the S&P quite a bit larger than the average win. That is true for the NASDAQ, that is true for the Dow, and that is more evenly distributed here between the Russell average win and average loss. So 3 out of the 4 have larger average losses than average wins. Russell pretty neutral with a pretty neutral win rate there on the Russell, whereas the S&P and NASDAQ have weak win rates and larger average losses here. Let's take a quick look at the results distribution. I've got the S&P selected, and you can see by looking at this graph, the graph is showing the results of the historical trades with the trade count on the vertical axis. So the taller the bars, the more frequently they have happened. And then the horizontal axis shows the P&L in dollars based upon trading a single contract, where you've got zero dead center here in the middle of the graph. The further to the left you go, these red bars are the bigger losing days. The further to the right you go, these would be the bigger winning days. And you notice there's nothing up here on the big winning days here in green. You do see quite a few big losing days here in red. So historically, the bigger moves have been happening on the downside as well. And you can see here in the one standard deviation area, which is this blue highlighted area, the zero line is skewed to the right here. There's just a handful of winning trades included in this, and they are on the smaller side, whereas there's a lot more losing trades within this one standard deviation area, and they stay larger as you move out some. So there's not as many super small losers on the losing side like there are super small winners here on the winning side, and those really drop off. So looking at this, it's obvious there's a lot more taller red bars on the extreme side of the graph. So hopefully you found that helpful. Good luck today, and we'll see you next time.